This is Brad Heddick with Commercial Lending X. Hot off the presses. The economy is impacting banks and credit unions. We have got to talk about this. Important information for all of you today. I'm going to dive right in, no delays. So you might think I'm joking. You might think I'm kidding. And I am a little bit. But the truth of the matter is banks and credit unions are being negatively impacted by the market right now. Banks and credit unions have capital in reserve, and they must maintain a certain amount of capital to operate. That capital provides protection that if there's losses, the bank can absorb those losses. Capital is typically invested in investments that the government deems are safe and protected. Oftentimes, those are assets in the bond markets, and a lot of times they're government-backed bonds. Well, as interest rates have soared, which they definitely have this year, the value of those assets in bank portfolios has plummeted. What does that mean? Well, it means the capital that banks have has fallen dramatically. Now, the good news is the federal regulators allow banks to designate assets like that held that they plan to hold until maturity. So now, if a bank has their capital tied up in those bonds and the value has gone down, the good news is the Federal Reserve does not require those institutions to take an immediate loss on those assets. They can designate those assets as assets that they're going to hold until maturity and keep them on their books at the value that they paid for them. However, when they need to borrow money from the Federal Reserve and other entities that do look at their adjusted capital, assuming that they have to liquidate those securities, it limits their borrowing power in the future. So what does that mean? If they can't borrow money, they have less money to lend. If their capital is down or ultimately gets amended down, they will then have less capital to lend. I don't want to say we'll have a repeat of 2007, 2008 during the Great Recession when banks had to freeze their lending because their capital just got wiped out. Their capital's not getting wiped out, but it has adjusted down because of the market conditions. So I do think we're going to start to see some institutions freeze lending, and maybe some institutions start not to renew loans to shrink their balance sheets because of this perceived capital risk. To further complicate things, during the pandemic, deposits rose dramatically. Every bank saw a huge increase in their deposits. The government pumped money into people's pockets, and a lot of it went into bank accounts. Over the last year and a half, we've started to see those deposits running off of the balance sheets of banks. Why is that a problem? Well, banks lend their deposits. Believe it or not, loans sit on a bank's book as an asset because it's something that earns money for them. And deposits are liabilities. Doesn't make much sense, right? You'd think the deposit would be the asset, but the deposit's actually liability because that is what a bank has to pay for, right? And that's something that can leave anytime the borrower wants it to leave. Banks don't typically earn money on their deposits unless they turn around and lend them out. So what is happening right now is because deposit levels are going down, banks don't have as much capacity to lend. It's hit the credit union market extremely hard. In fact, I'm aware of numerous credit unions that have more or less frozen all their commercial lending because of a lack of liquidity and deposits to continue lending. This is going to continue to be a problem that I think is going to persist through most of 2023. One last thing I'll point out is there are some institutions suffering from some big concentration risks as well. There are a number of banks that did a lot of lending into commercial real estate, specifically office and retail. Both of those segments have been hit very hard, and we've seen the ratios to capital for a lot of these banks skyrocket for what they have in office and retail. And the regulators are starting to come down on those banks. They don't like those ratios being so high. So I think we're going to see some banks that historically have liked to lend on office and retail properties start to back off of and not lend on as many as those properties. And then again, potentially some renewals that won't get done. This is nothing to completely panic over. The lending market is constantly in turmoil and cycles. And the good news is that today there's more non-bank lending solutions than there ever have been in the past. So there's plenty of alternative lenders out there. But I do want borrowers to realize that there are some market and financial constraints hitting the banking and finance sector today that are going to be an issue for the next year. So it's more important than ever if you have a loan that's going to renew in the near future that you get with your lender and one, find out if they're going to renew it. And if not, you start looking for that new lender sooner than later. Don't wait until the last second. You want to be sure that you're protected and safe. If you have any questions, always can reach out to me. Thank you for watching and have a great day.